Mr. Gorakshakar, retail investors should then be doing to safeguard their interests? Then how do they look beyond the glamour of ringing bells and implications of a listing pop that you've talked about, right? Is there really a case to really sharpen their focus when it comes to research on the fundamentals of the company that they're looking at as well?
No, I think first of all, a very simple thing is that investors should not be carried away by the hype. I think we have seen examples like Paytm, Nykaa. These were clear cases of selling the narrative and not having the cash flow. So I think today Paytm has not even reached the IPO price at what it issued the shares. So definitely, investors in these cases are completely, they lose a lot of capital in the longer term. My sense is that, I think even if the narrative is strong, the runway is very strong, I think it doesn't make sense to buy the stock at any rich valuation. So it's better to wait for the stock to get listed. Typically, what we see is after, say, 3 to 6 months, the excitement in such kind of IPOs dies out. You get the stock more or less at the IPO price or sometimes even below the IPO price. That would be a good entry point because, smart investors definitely who are wanting to make long-term value, they would obviously get the best ROI only when they buy at the right price. So my sense is, there's no hurry which investors should do in applying for these IPOs because clearly this is a momentum game. I think over the next 3 to 6 months, if the performance does not meet to market expectations, I'm quite sure that there could be a selling wave, and this definitely is a very natural corollary. So my sense is that investors should be very, very selective. I think LG was an exception, but if you look at the other IPOs which are hitting the market now, I think clearly, it's a word of caution. I think, investors would learn the hard way. So it's better to be selective and not go for every IPO which comes with a public offering.